Should you still buy SCHD when these three ETFs beat it by far? Today, we're going to dive into a strategic financial deep end. We're talking about a powerful concept, not just participating in the dividend game, but winning it. For years, the Schwab U.S. Dividend Equity ETF, or SCHD, has been a beloved cornerstone for many dividend investors. And for good reason. It's reliable, consistent, a true workhorse. But what if I told you there are equally stable, yet significantly more dynamic exchange-traded funds, or ETFs, that have quietly been outperforming SCHD, accelerating the journey towards substantial financial prosperity? Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Think of it like this. SCHD is a sturdy, dependable sedan. It gets you where you need to go, reliably, every time. But what if you need to get there faster, with more horsepower, and a touch more agility to navigate the changing roads of the market? Today, we're unveiling 3 high-performance vehicles that could turbocharge your dividend growth and get you closer to that ambitious goal of generating $10,000 a month in dividend income with the same starting capital. We're talking about intelligent investing that moves beyond the basics. The SCHD baseline, a trusted companion. Let's begin by acknowledging SCHD. It's a fan favorite, and deservedly so. With its attractive dividend yield, incredibly low expense ratio, and a remarkable track record of over a decade of consistent dividend growth, it's a staple in many long-term investment portfolios. It holds household names, companies like Pepsi, Coca-Cola, and Verizon. These are titans of industry, boasting strong cash flow, rock-solid fundamentals, and a long, proud history of rewarding shareholders. SCHD embodies stability. It's the quiet, consistent hum of a well-oiled machine in your financial planning. It just works. But here's the crucial insight. While SCHD is a steady performer, it's not designed to be a rocket ship. Its strategy leans heavily on mature, value-oriented companies. This means it often has limited exposure to the very sectors that are currently driving the most explosive growth and innovation in our economy. Think cutting-edge technology, artificial intelligence, and disruptive innovation. In today's rapidly evolving market, a lack of exposure to these high-growth areas can, paradoxically, limit your overall wealth creation potential, even from dividends. Because the real secret to building generational wealth isn't just about income. It's about income plus growth. Quietly, almost stealthily, several other ETFs have not only matched SCHD's dividend strength, but have significantly outperformed it in total return. Why? Because they prioritize growth alongside income. And if your ultimate goal is to achieve truly transformative financial outcomes through both passive income and capital appreciation, you need to explore what else the market has to offer. So, let's peel back the layers and uncover 3 powerful ETFs that could redefine your journey toward financial independence. Strategic Playbook Entry 1, DIVB, the growth catalyst with a buyback edge. Our first contender is a true sleeper hit, DIVB. You might not have heard much about the iShares Core Dividend Growth ETF, but since its inception, it has been a quiet force, consistently outperforming SCHD. Let's look at the numbers. Example: imagine 2 parallel paths. SCHD's path is smooth, well-worn, and predictable. DIV's path started a bit later, but it's been steadily gaining ground, offering a more direct route to your destination. DIVB has delivered an annualized return significantly higher than SCHD over comparable periods. This isn't just luck, It's a result of a highly effective, powerful combination: strategic growth and a focus on shareholder rewards. DIVB tracks an index that doesn't just look for companies paying dividends. It actively targets those that are also buying back their own shares. Why is this critical for long-term investors? Because when a company reduces the number of outstanding shares through buybacks, your existing shares represent a larger piece of the company's earnings. Your slice of the pie gets bigger, leading to enhanced earnings per share and, ultimately, more robust wealth creation. It's like a financial slingshot, propelling your investments forward. Its top holdings include heavy hitters with serious cash flow and share repurchase power, and unlike SCHD, DIVB offers meaningful exposure to the technology sector, allowing you to tap into the innovation engine driving today's markets. This balanced approach, blending solid dividend payers with companies actively engaged in share buybacks and exposure to growth sectors, makes DIVB a formidable engine for compounding returns. For instance, consider investing $100,000 into DIVB. The power of compounding means that in a little over 2 decades, that initial sum could be generating a substantial annual income, with your portfolio value approaching $1 million. Extend that timeline further, and you could be looking at a 6-figure annual passive income stream, all from a single, intelligent investment decision and the unwavering power of time. This is how you build a significant retirement income. Strategic Playbook Entry 2, VIG, the silent compounding giant. Next up, we have VIG, the Vanguard Dividend Appreciation ETF. This fund doesn't scream with flashy high yields. Instead, it operates with quiet, powerful discipline, compounding in silence and dominating over time. Its strategy is elegantly simple, yet profoundly effective. VIG only includes companies that have consistently increased their dividends for at least a decade straight. Metaphor: think of VIG as a marathon runner. It's not about quick sprints, but about the steady, consistent pace that ensures victory over the long haul. To raise dividends consistently for 10 years, a company must possess real, sustainable earnings growth. It must navigate economic storms, manage debt prudently, and treat its shareholders as genuine partners. These are the companies that play the long game. You'll find names like Microsoft, Apple, Visa, and JP Morgan Chase within VIG's portfolio. These aren't just companies paying out cash. They are compounding machines that grow their earnings, raise their dividends, and aggressively reinvest in innovation and market leadership. VIG's edge isn't in chasing the highest current yields. It's in identifying resilient giants that can grow and expand their payouts across decades. This disciplined approach consistently pays off. While its current dividend yield might appear modest, its impressive dividend growth rate is what fuels your long-term wealth accumulation. This is how a small snowball transforms into an unstoppable avalanche of investment returns. Imagine that same $100,000 starting point with VIG. In a similar time frame to our previous example, you could see your annual dividend income approaching or exceeding 6 figures, with your total portfolio value reaching multi-million-dollar figures. This showcases the incredible force of disciplined growth and the consistent reinvestment of rising dividends. This is truly an exercise in smart money management. Strategic Playbook Entry 3, FDVV, the turbocharged blend. Finally, let's turn our attention to the underdog, FDVV, the Fidelity High Dividend ETF. It might not generate the same buzz as SCHD or VIG, but don't let its less prominent profile deceive you. This ETF has been quietly delivering knockout performance, driven by a beautifully balanced strategy. FDVV targets large and mid-cap U.S. companies that offer a potent combination: reliable dividends and long-term growth potential. It's not about blindly chasing the fattest yield. FDVV seeks out businesses with strong fundamentals and ample room to expand. This strategic blend translates into greater stability and significant upside potential, offering a sweet spot for income-focused investors who also crave capital appreciation. Analogy: FDVV is like a hybrid vehicle, offering the fuel efficiency of a sedan for consistent income, combined with the powerful acceleration of a sports car for growth opportunities. Its portfolio boasts tech giants like Apple and Microsoft, alongside established names like ExxonMobil and Johnson & Johnson. This strategic inclusion of technology exposure gives FDVV a distinct edge over more traditional dividend funds. The numbers speak for themselves. FDVV has consistently outperformed SCHD over comparable periods, demonstrating its ability to deliver quiet, consistent outperformance. While its dividend yield sits comfortably between VIG and SCHD, its strong share price growth rate is where the magic happens. This means you're getting a powerful middle ground, a balanced engine built to compound beautifully over time. Consider your $100,000 investment with FDVV. In a similar 20-year horizon, you could be generating a 5-figure monthly passive income, with your portfolio value well into the high 6-figure or even multi-million-dollar range. This is the compelling outcome of combining a solid yield with smart growth, allowing compound interest to work its extraordinary magic. This is a clear pathway to significant financial security. The power of blending, your next-level portfolio. So the big question: should you abandon SCHD entirely and simply pivot to these 3 ETFs? Not necessarily. The true genius of a sophisticated investment strategy isn't about discarding a good tool. It's about understanding its limitations and complementing it with others. SCHD is, without a doubt, a rock star, consistent, low-cost, and built on quality. But even rock stars have blind spots, and SCHD's biggest weakness is its limited exposure to the high-growth technology and innovation sectors, the very areas driving the future. This is where DIVB, VIG, and FDVV step in. DIVB fills the tech gap that SCHD often misses, amplifying your earnings per share through its focus on buybacks. VIG acts as your consistent compounding engine, relentlessly focusing on companies that not only pay dividends but reliably grow them, building long-term wealth with quiet determination. FDVV is the balanced powerhouse, offering a compelling blend of higher yield than VIG and more growth potential than SCHD, perfectly positioned to compound effectively. When you thoughtfully combine these ETFs, you're no longer just betting on a single strategy or a single type of company. You're constructing a diversified, dynamic income-generating portfolio that is designed to grow, compound, and adapt to changing market conditions. This is how you accelerate your journey toward $10,000 a month in dividend income without sacrificing stability, growth, or critical market opportunities. This is your blueprint for maximum wealth growth. Key learning points. Diversify beyond single strategies. Relying on one ETF, even a good one like SCHD, limits your exposure to crucial market sectors driving future growth. Growth fuels income. Prioritizing ETFs with strong dividend growth histories often leads to higher total returns and ultimately larger passive income streams over the long term. Share buybacks matter. Companies that actively repurchase shares can increase your stake and earnings per share, contributing significantly to wealth accumulation. Technology is key. Integrating ETFs with exposure to the technology sector and artificial intelligence can unlock additional capital appreciation and future dividend potential. Compounding is your ally. Consistent reinvestment of dividends, even small ones, combined with growth-focused ETFs, creates an exponential effect on your investment returns. Important disclosure. Please understand, the information shared in this video is for educational and informational purposes only. It is not and should not be considered financial advice. Investing in exchange-traded funds and dividend stocks carries inherent risks, including the potential loss of principal. Market conditions can change rapidly, and past performance is not a guarantee of future results. Before making any investment decisions, especially when dealing with significant sums, we strongly urge you to consult with a qualified, independent financial advisor. They can provide personalized advice tailored to your specific financial situation, risk tolerance, and investment goals. Your next step towards financial power. There it is, a comprehensive look at how to potentially accelerate your path to financial independence and achieve your ambitious dividend income goals. Don't just choose one. Consider how a strategic blend of these powerful ETFs can build a diversified income engine that leverages each strength, income, growth, and resilience. Because real wealth creation isn't built by picking a single star. It's built by creating a powerhouse team that wins together for decades to come. If you found this discussion truly valuable and feel enlightened about your investment options, please take a moment, like this video, to help us reach more serious investors. Subscribe to our channel for more in-depth strategies and cutting-edge insights into wealth management. And most importantly, leave a comment below. Share your thoughts, your own experiences, or any questions you have. We'd love to hear from you.